at that 20-day moving average, 19,450, 19,451. So we're at the 20-day moving average. The key is for the markets to sustain above these levels, put in a bit of gap between the current levels and the 20-day moving average, and then maybe some short covering will also kick in. As promised, let's continue the conversation on markets. Amit Khurana, the head of equities at Dolat Capital, is now with us on the show. Amit, the big worry right now is this monsoon deficit, the possibility of rising food inflation, rural distress. Are you in any way positioning your portfolio to account for this scenario?
Thank you. Thank you for inviting me. I think monsoon deficit was a concern which was pretty well discounted even before the monsoon season actually started in India. Fortunately, July rainfalls did offer us some respite, but then August expectedly has turned out to be a pretty dry month, so to say, across good part of India. I would probably say it's a mixed picture at this stage from a perception on the equity valuations. Monsoon impacting that earnings growth and overall other aspects of the investor sentiment. I do not think that is such a negative at this stage because largely I think the sowing season did pick up. Some of the shortfalls that we saw in the sowing in the early part of the monsoon season did catch up. But point taken that ultimately it has to sort of cover up the shortfall, and hopefully if it doesn't work out to be the case, then we will have to see the impact of this. But let me put that into context. When we started the monsoon season, it was a much more, shall I say, skeptic, sort of situation, which has not been as bad as it was the case earlier.
So no changes to your portfolio as of now?
No.
Okay, Amit, hi. I was going through the note that you had shared, the strategy note. Good to see that your optimism is intact, though a lot of people are talking about the concerns and, potentially, higher interest rates for a longer time, etc. So tell us the theses, because you're retaining a positive stance on the market. You still seem to be comfortable with valuations, despite what has been an entire month of consolidation. The Nifty has done nothing, but it's been in a 400-point range. Mid-caps are still flying. So from here on, let's say, to play this market till the end of the year, what should the construct be?
Well, our construct has been largely domestic consumption-led, and that has been the situation right from the start of the calendar year. Essentially, this note only reiterates that stance that we've been carrying, and we have tried to sort of focus more on the mid and the small cap basket this time around. So there are two basic constructs that we've try to base our hypothesis upon. One is that we see a rebound in domestic consumption going through pockets from hotels to travels to the urban centric towards more on the semi-urban and the rural side. We believe that the last 18 to 24 months of muted consumption will eventually reverse. That's point one. And secondly, we also feel that the corporate balance sheets and the cash flow visibility is far stronger than what was the case last financial year, where the inflation impact and the impact on gross margins and EBITDA margins took away all the earnings growth away. We see that reversing now. Now, having said that, we've also seen a serious amount of re-rating in some of the mid and the small cap names, but I guess it's more of a mean reversion. We believe that the next 12 to 18 months of earnings visibility remains pretty high. And even though rates will stay higher for longer, but I guess that the working capital discipline, an aspect which we have highlighted in our note, and the fact that the cash flows continue to be pretty reasonably healthy for the companies will help the equities valuations to sustain. So that's the broad two hypotheses that we're running. And domestic consumption, a mix of staples and discretionary, and a bit of semi-rural and rural, I think will probably be the outperformer for the next 2 to 3 quarters as we see it.
Okay, got it. Amit, thanks for joining us. What is the kind of earnings growth that you're, penciling in for this year for all of FY24? And also, within the mid and small caps, you did mention domestic consumption. Is there any pocket which you feel has become way too expensive to look at now? Because some of these smaller pockets have seen pretty big rallies already within this space. So is there something from that, from this space that you would absolutely avoid right now?
There are no absolute awards in India at any stage. I mean, there is always appetite for, valuing these models more and more aggressively. But having said that, I think it's more of a stock-specific phenomenon, which we've highlighted. Some of the, auto and stocks, they look richly valued, and something which we've highlighted in our note as well. some of the urban discretionary stocks, for example, hotels as a category, in some of the names we find valuations are pretty rich and quite stretched. But the cycle is still extremely strong, and therefore we are preferring to play it through some of the other names. As for the the first part of the question that you asked, I think our earnings typically are trajectory, moving towards high teens at an aggregate level for the coverage universe that we have. But for the mid and small cap, it is trending more towards mid 20s and high 20s. And in some of the pockets, we are also finding high 20s as a case in point for the next couple of years of CAGR. So I would say this is a cycle which probably we are seeing after a pretty long time, that the sustainability on a 2 to 3 year basis for some of the mid and small cap names will trend towards 2 to 3 year sort of time frames rather than just 1 year, which was the last decade that we saw 1 year good numbers, and then second year it would normalize. But this is probably one of the rare instances that we're seeing after a long time, that earnings will trend towards high teens at the aggregate universe level for us, and more towards the mid 20s for the mid and the small cap universe for our coverage.
Amit, where do you stand in a company like Zomato? We've seen large PEs pare down their stake. Tiger Global completely exited. SoftBank today has reportedly sold some stake, brought it down by over 1%. But all these shares have been lapped up by mutual funds, a lot of HNIs, and there is far more conviction now in the fundamental business of Zomato, the profitability, Blinkit acquisition, etc. Are you convinced about Zomato? Would you enter in at current levels?
No, I mean, if you look at our rating, Zomato is something which is a negative stance for us, or right through. So in that sense, our concern is more on the Blinkit part of the business, the size and the scale up that they can do, and especially given the competition that they face. But I take your point. There has been a few developments which obviously we are also observing. But at this stage, our stance of Zomato is more of a negative side rather than being, sort of on the positive side.
What are the developments? What are the developments which has caught your curiosity?
So basically the Blinkit scale up, I think that's the most important, because ultimately if you see the food delivery part, we've seen the evidence that there is a limitation at a certain stage that all these models will face in terms of the actual addressable market. And as you go down the curve on the food delivery business specifically, the unit economics, especially for the smaller cities, is a big challenge. Now, therefore, the diversification into Blinkit as an offering is something that they have been trying to position. Now, if that were to show a scale up and that unit economics start performing and the volumes ultimately is the real evidence in this business, that has to ultimately show an evidence. And that's something that we are keenly observing. So at this stage, we are not pushing for Zomato officially.
Okay, Amit, so quickly, just leave us with, since mid caps and small caps are where your focus is, leave us with 2 or 3 interesting ideas.
Well, there are quite a few actually which we've highlighted in our note. If I were to highlight a few, especially I think hotels, chalet hotels is something that we believe is in a very, very good stage, in the sense that their non-hotel portfolio will do pretty well. And that will become a significant driver of earnings in FY25 and beyond. And remember, this is also a hedge to the core hotel business, where the cycle will eventually top out in FY25, and the kind of visibility that they're building up seems to be pretty well placed. The other new initiation which we've done, and we feel pretty confident, is IndiaMart, which is a B2B model. We believe that the entire restructuring of the business, the acquisitions, the integration process seems to be largely getting over, and therefore their ability to monetize some accounts should play out relatively better.
Okay, got that. So hotel stock and possibly IndiaMart. Thank you very much. Look forward to discussing more of these themes next time. You have a good day, and we'll catch up again soon. Okay, well, Amit was talking about Zomato, so the conversation has already shifted to food, and we'll go food full